Howdy, Jacob here. Today we're looking at next company in our dividend yield screener, Ebix. All right, so initially zero point 0.2 price to book. Wow, 27 PE. Interesting. Hmm. Looks like their return on invested capital has almost consistently been declining and has since 2016, very consistently declining. Their earnings per share have also been declining, not been growing, or I guess been a little flat for a couple of years and then declining actually. Operating margin and gross margin have just been declining like crazy. That's pretty unattractive. I assume I'm going to have to lower some assumptions here with that. Um, Initially, this looks attractive 136 million market cap, 47 million enterprise value. But when I go to their balance sheet, I see that they 600 million roughly moved from long-term debt to short-term debt. So I presume this is going to be a company that refinances this debt and then sends roughly 600. I mean, I'll have to read the report if it gets close or if it looks close, but send 600 million back to the long-term debt, and then that would make this enterprise value more like 700 million. Um, but they've been making money. I mean, their cash flow has been positive, which is good. Like I said, earnings have been declining to where it's almost negative now. And their revenue dropped like crazy. What happened there? Wow. Gross profit is, I mean, this gross profit as a percentage is pretty good. That's like 40%. No, that's not good. I guess better than it has the last 2 years. So cost of goods sold went down quite a bit, but their sales, general, and admin is much higher, um, which gets us to a little bit lower operating profit. And then due to them going into debt, where over here they had 200 million in debt, now they have 600 million in debt, and interest rates have risen, so that expense is going to be greater. And you can really see it here how it's 90 million going towards paying interest. She leaves us 5 million net income on a free cash flow basis, 55 million. 55 million and compared to 136 million market cap though is a 2.87 price to free cash flow. So that's pretty interesting. The yield is 6.94% because it's declined so much, and the yield is given the price because the actual amount of the dividend is fixed. So if the price were 6 times higher, this would only be 1%, but because it fell 6 times, it's 6.94% yield. Pretty great. How much are they paying out for that dividend? 9 million. I mean, they can afford 9 million. Like that's nothing. So okay, let's get to making some assumptions here. So revenue, it looks like it's been increasing quite a lot, and then you can see that most recently it's actually declined, and so I might assume zero growth because I mean they can find ways to make money. They've literally made money every single year or increased revenue every single year except for most recently. So maybe you just assume it goes flat. I mean, I'm just being conservative because all the margins. I might be conservative on a lot of measures here just because margins have gone down so much, and just there's just a lot against the company now, which could make it such an attractive price that we want to buy it. But we got to be sure. And so, I mean, these margins have been going down a bunch. I might do 5 and 4. I mean, maybe they can stick around the 6%. Maybe they jump back up to the in the mid teens. That'd be great. Um, we'll look at this preliminarily though. So share change. They probably haven't been buying back shares. A little bit of stock based compensation. I might just do from no share repurchases, but they will have stock based compensation. No growth company, 10 PE. Whoa, okay. And like I said, they can afford 9 million of dividends for a payout. So Interesting. Okay, this would definitely be a company I'd want to look more into. Looks like, the 6% yield, 6.9% yield looks reasonable. Maybe there's a chance that it's just been so negatively viewed recently that the stock price is just down so much. But there could be reason for that. Maybe these margins really can hold, and maybe it will go down to nearly nothing. I mean, there's a chance that that happens, but with me right now, I don't see a reason to um, change any of these assumptions without looking more into the company. So I'll have to do a deeper dive on this, but for right now, it looks attractive. So I hope other people do some research on this company, see if it makes sense for you, and I'll have an in depth video out shortly on it. So thank you and have a good rest of your day.